Hello everybody, this is Manisha and I would like to give you an overview of the roadmap for tax in the Middle East. There are four parts to this thing: background, VAT fundamentals, VAT impacts, a successful VAT implementation. I would like to give a brief about this thing so that we can understand it. Before starting, let us understand the background. Introduction to tax reforms in the Middle East. Why did we have to take out the tax reforms? Why did we have to implement tax? Because, as you can know, IMF said in October 2015 that the Gulf state would have a combined fiscal deficit of US $700 billion, which would exceed that if it does not undertake any reforms for any tax in the country. VAT is expected to yield 12 billion dirhams in the first year of its implementation and 20 billion dirhams during the second year. First, let's just have an overview of this thing. 2016, we are thinking by 2020 all the countries will be implementing VAT. Like in 2016, 17, 18, 19, there have been various procedures being carried out in the UAE and various other Gulf countries for the implementation. First, what is the mechanics? Introduction of VAT. VAT is value added tax, and as you can know, it has to come up at 5%. It has been told by the FTA, Federal Tax Authority, that it will be at 5%, and is proposed to be implemented from 1st January 2018 in the UAE. Federal Law Number 7 of 2017 on tax practices is enacted and published for laying down the tax procedures. Businesses act as unpaid tax collectors and account for and pay VAT monthly or quarterly usually. Businesses have to pay this thing. This we'll discuss later. How are we going to pay and do this thing? Errors can lead to significant penalties, which is not yet been told by the government. It will come up as soon as possible. Now, value added tax is an indirect tax. It's not a direct tax. So the question whether VAT is applicable on the personal income or payroll or anything is wrong. It is only applicable on the supplies of goods and services that are bought and sold. So our first tension is relieved that it's not a direct tax and we don't have to pay the tax on our income. It is the most common type of consumption tax around the world, and 150 countries have implemented it already. It is charged at each and every step of the supply chain, which ultimately ends up to the consumer paying VAT. Businesses plays the role of a collector on behalf of the government. Now, we should understand who has to do a mandatory registration. What is the threshold first, and who has to do a voluntary registration? Threshold for every taxable person resident of a member state whose value of annual supplies in the member state exceeds or is expected to exceed the mandatory registration threshold. So mandatory registration threshold is 3,75,000 dirhams and voluntary registration threshold is 1,87,500 dirhams. Threshold is what? Total value of supplies made by a supplier taxable person for the previous 12 months or total values of supplies of the subsequent 30 days. Value of exempted supplies will not be considered in this. I hope I have made you understand that. Now first we will look at it with an example. Raw materials. It is at 100 rupees, 100 dirhams. 100 dirhams, VAT 5%, so 100 plus 5. Supplier, the value is 150 and 7.5 is the VAT. So, but the supplier is going to pay 7.5 minus 5, that is 2.5 will be his VAT. He will not be needing to pay 7.5 because he has to pay output VAT minus input VAT. That is the net VAT payable. Let's come to manufacturer. His value is 200 and he has to pay 10 is his VAT. But he will be paying 10 minus 7.5, which is the input VAT. So he'll be paying 2.5. Distributor, 250 plus 12. 250 is the value. So the VAT comes out at 12.5. 5% VAT is 12.5. But he will be only paying 12.5 minus 10, the VAT which the manufacturer paid. So the distributor will be only paying 2.5. Retailer, 300 is the value of the good, and on 300, 5% VAT comes out to 15. But the retailer will be paying 15 minus 12.5, the VAT paid by the distributor. So the total amount is 2.5. 400 is the consumer value. It's being sold at 400 to the consumer. Plus 20, that's the VAT on this thing. But the consumer will be paying only 20 minus 15, that's 5. So as you can see, it will not be affecting your pocket that much. It'll be minimally affecting you, which will be benefiting you in the long term. I hope I'm clear with this. Mechanics of VAT. Accounting for VAT. VAT recoverable from customers minus VAT payable on business purchases is the net VAT. Payable to the tax authority, refundable from the tax authority. Accounting for VAT. VAT returns. Now let's come up to the VAT returns, which has to be submitted periodically together with payment, normally 3 months or monthly. Authorities sometimes have discretions. It depends on country to country. Additional reporting requirements could arise in intra-GCC trades. Penalties have not yet come up. There are certain things which will need to be more specifically coming up. Place of supplies rules will determine the country in which VAT is chargeable. Goods. The basic rule is that the place of supply is the location of goods when the supply takes place. Services. Basic rule. Business to business, place of supply is where the recipient belongs. Now can you see, goods is that the place of supply is the location of the goods when the supply takes place, while in services, place of supply is where the recipient belongs, and business to consumer, place of supply is where the supplier belongs. Now VAT will be chargeable on these three things: at the location of the goods, supplier in business to business, recipient where the recipient is, and where the supplier belongs. Categories of supplies based on tax. Supplies, goods and services. Exempted supplies, input tax is not taxable because they are exempted, so no tax. Taxable supplies 5%, as you know, and 0 rate. There are two categories which have come up, we'll discuss it later. Input tax is deductible on that. 0 rate has an input tax deductible to it. Reverse charge. UK company gives legal services to UAE company. UAE company gives, like on this reverse charging, same results as if purchasing locally. This is 200 dirhams to the tax authority, and input tax, that's the output tax, and input tax is 200 dirhams from the tax authority. So it will be 4,000 dirhams is the value which the UAE company will be paying to the UK company.